We've dedicated recent days to examining the turmoil. We've studied the sudden crashes, the supply shortages, and the pricing differences between New York and Shanghai. These represent indicators of a fractured market. They're the aggressive shocks of a framework that's falling apart at its foundation. Yet while traders were yelling at their monitors, and while the computer programs were battling over cents, the most important development in the chronicle of the silver market occurred quietly with the signing of a document inside the Oval Office. On Wednesday, January 14, 2026, President Trump authorized a document that formally concludes the 50-year conflict against silver's value. The document represents a proclamation under Section 232 of the Trade Expansion Act. To the average observer, it appears like merely another document of bureaucratic records. Yet if you examine the text, if you truly analyze the legal wording, you understand that this represents a declaration of economic sovereignty. For the first time in decades, the United States government has acknowledged that the low value of essential minerals isn't an advantage to the economy. It's a danger to national security. Let's examine the precise language utilized in the proclamation. The President announced that America's overdependence on foreign imports of refined essential minerals represents a direct danger to the security of the nation. He didn't indicate it was an inconvenience. He didn't indicate it was a trade deficit. He indicated it was a danger. In governmental terminology, a danger authorizes exceptional actions. It releases powers that are typically reserved for wartime. Yet the actual revelation that the information that ought to make every short seller in the world exit their position immediately can be found in paragraph 13. The proclamation clearly states, "Depending on the outcome of such negotiations, I may consider alternative remedies in the future, including minimum import prices for specific types of critical minerals." And once more in the operative section, it instructs the Secretary and the Trade Representative. 2. Consider price floors for trade and critical minerals. Price floors. Let that idea register. For 50 years since the United States abandoned the gold standard in 1971, the approach of the government and the Federal Reserve has been to diminish the value of precious metals. They desired gold and silver to be inexpensive because costly metals indicated a weak dollar. They utilized the futures markets to limit the value. They used leasing to saturate the market. Now suddenly the approach has reversed. The government is declaring that values are too low. They're declaring that instability and inexpensive imports are eliminating our capacity to extract these minerals domestically. Why would they implement this? Why would a government that opposes inflation desire elevated commodity values? Because they have examined the supply chain and they have understood the frightening truth. You cannot construct a missile with paper agreements. You cannot construct a solar panel with a derivative. You require physical metal. And you cannot maintain a domestic mining sector if the value of silver collapses to $20 every time a bank chooses to short the market. By invoking Section 232, the President is indicating that the period of financialization is finished. The period of industrialization has started. In a financialized economy, you desire low commodity values to maintain inflation down and stock values up. In an industrial economy, you require stable, elevated commodity values to motivate miners to extract holes in the ground. The United States has understood that it cannot rely on China for the materials necessary to conduct a war or construct a grid. Yet to sever that reliance, they must reconstruct the mining sector from the beginning. Mining is capital intensive. It requires billions of dollars to construct a mine. No investor is going to invest $1 billion to construct a silver mine in Nevada if they believe the value might collapse next week because of an algorithm in Chicago. So the government must intervene. They must eliminate the investment risk. They must establish a guarantee. That's what a price floor represents. It's a government-sponsored put option. It's the United States declaring to the mining sector, go ahead and construct the mine. If the market value declines, we will ensure you remain profitable. This transforms the risk profile of silver entirely. For the previous decade, the risk was consistently to the downside. We existed in apprehension of the crash. We existed in apprehension of the regulatory crackdown. Now, the government is informing us that the downside represents a national security risk. They're informing us that they require the value to remain high. This proclamation effectively positions a safety net under the market. It indicates that the crash to $90 we witnessed today isn't the beginning of a bear market. It's a volatility event that the government is actively attempting to resolve. The decline in value that frightened retail investors is the exact issue the president is attempting to fix. When you comprehend this, the daily volatility becomes insignificant. The trend is now supported by the complete force of the United States executive branch. We're transitioning from a market dominated by bankers who benefit from volatility to a market secured by generals who demand stability. The Section 232 order represents the line in the sand. It separates history into two periods: the pre-proclamation period, where silver was a speculative toy for Wall Street, and the post-proclamation period, where silver is a strategic asset for the Pentagon. We're currently in the post-proclamation period. The rules have transformed, the objective has transformed, and the value is about to transform to reflect that reality. In the following part of this deep dive, we're going to investigate the economic logic behind this shift. We're going to clarify why inexpensive silver is actually a subsidy to our adversaries, and why costly silver is the sole path to American sovereignty. We'll examine the mining cycle, the destruction of capital that happened during the suppression years, and why it will require a sustained period of triple-digit values to repair the damage. The government has reversed the switch, the suppression machine has been disabled, and the support machine has been activated. To comprehend why the United States government is suddenly focused on price floors for silver, you must unlearn everything you've been instructed about modern economics. You must reject the assumption that low values are beneficial. For 40 years, the Federal Reserve and the Treasury functioned on a single overriding principle. A strong dollar indicates low commodity values. They believed that if they could maintain the value of gold and silver down, they could conceal the inflation generated by their money printing. They believed that inexpensive raw materials would function as a stimulus for the consumer economy, and for a long period, it functioned, or at least it appeared to function. Yet there was a hidden cost to this approach. A cost that was not paid in dollars, but in sovereignty, by diminishing the value of silver to artificial lows, by maintaining it at $15 then $20. The West effectively eliminated its own mining sector. Consider the economics of a mine. It requires 10 years to permit. It requires billions of dollars to construct. It demands massive amounts of diesel, labor, and specialized equipment. It's one of the riskiest enterprises on Earth. If the value of silver is volatile, if it can collapse 50% in a year because of paper trading, no rational board of directors will authorize a new mine in a high-cost jurisdiction, like Nevada or Idaho. The risk is too elevated. The return is too uncertain. So, capital abandoned the sector. Investors ceased funding American mines. They transferred their money into tech stocks, into bonds, into anything that wasn't a hole in the ground. The outcome was capital starvation across the entire industry. The Western mining complex deteriorated and weakened. The skilled labor force retired. The equipment corroded and rusted. The exploration activities ceased completely. Yet while the West was starving its mining operations, the East was nourishing theirs. China adopted a completely different approach. They viewed mining not as a profit center, but as a strategic necessity. They subsidized their mining operations through state banking institutions. They provided inexpensive energy. They streamlined the permitting process. Chinese mining companies didn't need to worry about quarterly earnings reports. They didn't need to justify their existence to shareholders every quarter. They functioned under a different mandate. The mandate was straightforward: extract the metal, no matter the immediate financial cost. The result after multiple decades of this policy divergence is that China currently dominates approximately 60% of worldwide silver refining capacity. The United States refines virtually none of its own. We extract some raw ore from the ground. We ship it overseas to China. They refine it into finished product. They sell it back to us at a significant markup, or they retain it for their own purposes and themselves. This is not solely an economic dependency issue. It's a strategic vulnerability of the highest order. If tensions escalate with China in the coming years, if the government in Beijing decides to cut off the supply of refined silver to the United States, what happens then? Every solar panel, every advanced weapon system, every electrical vehicle manufacturing line that depends on silver grinds to a complete standstill. The Pentagon fully understands this risk. The Department of Defense has been issuing detailed reports for years warning about critical mineral supply vulnerabilities and dependencies. Yet reports don't construct actual mines. Capital constructs mines. And capital won't flow into the mining sector unless the return on investment is sufficiently appealing and attractive. That return is determined by the market value. If the value of silver is artificially suppressed through paper markets and derivatives, the return is insufficient. The risk is far excessive. The investment doesn't materialize or occur. This is the strategic blunder of the previous 50 years and beyond. By suppressing the value to maintain the dollar appearing strong and powerful, we eliminated our capability to extract the very metal we require to sustain our military and industrial manufacturing base. We essentially subsidized our adversaries and competitors while simultaneously starving our own producers. The proclamation signed by President Trump directly acknowledges this error. It declares in formal government legal language that the period of inexpensive silver is finished. The period of strategic silver has commenced and started. The Section 232 authority grants the president extensive and broad powers. It permits him to impose tariffs and duties. It permits him to establish quotas and limits. And most significantly, it permits him to establish minimum import values for critical materials. A minimum import value represents a price floor by another term and name. If the government declares that no refined silver can enter the United States at a value below $100 per ounce officially, what occurs then? The floor becomes absolutely real. It doesn't matter what the paper contract market in New York declares. If you cannot import silver below $100 per ounce, the domestic value must rise to match accordingly. This is how you reconstruct a mining sector from scratch. You establish the value high enough that domestic producers can function profitably and sustainably. You establish it high enough that investors will fund and finance new mining operations. You establish it high enough that China cannot undercut American miners with heavily subsidized exports. The government becomes the buyer of last resort in this scenario. If the value drops below the established floor, the Strategic Petroleum Reserve model directly applies. The government purchases and stockpiles. They establish a strategic silver reserve for the nation. They accumulate metal steadily. The value stabilizes at the floor. The mines remain operational and producing. The supply chain remains secure and intact. This isn't capitalism as traditionally defined. This isn't free market economics in the classical sense. This is industrial policy. This is mercantilism and protectionism. And whether you support or oppose it philosophically is entirely irrelevant because it's occurring right now. The executive order is authorized and signed. The clock is ticking down. The government has concluded that national security supersedes market efficiency and priority. And in that calculation, the value of silver must increase substantially. The market hasn't fully absorbed this shift yet. The algorithms are still trading silver like it's merely a speculative commodity for profit. They're still executing the same strategies that functioned successfully in 2015. Yet the game has transformed completely. Silver is no longer merely a trade for speculators. It's a strategic material of national importance. It's moving from the commodity exchange to the Pentagon budget allocation. When this realization spreads throughout the market, when the market comprehends that the government explicitly desires elevated values for strategic reasons, the repricing will be violent and dramatic. The smart money already understands this dynamic. They're positioning ahead of the July deadline strategically. They recognize that once the price floors are established officially, the opportunity disappears forever. The transition from a financialized market structure to an industrialized market requires a fundamental shift in mindset and thinking. In the previous world, you purchased silver hoping the Fed would print money and devalue the dollar currency. In the new world, you purchase silver because the government requires it to construct weapons and energy infrastructure for the nation. The motive has transformed entirely. The purchaser has transformed completely. Wall Street wanted silver suppressed and controlled. Washington desires silver elevated and stable. This is why the Section 232 proclamation represents such a profound shift in policy. It's not merely a trade policy adjustment or tweak, it's a recognition that the United States cannot maintain its position as a global superpower if it doesn't control its own supply chains completely. And you cannot control a supply chain if you don't possess the industrial capacity to extract and refine the materials domestically. To reconstruct that capacity from the ground up, you require capital investment. To attract that capital, you require returns and profits. To guarantee those returns, you require stable, elevated values consistently. The government has finally connected the dots clearly. They've understood that inexpensive silver equals Chinese dependence and vulnerability. They've understood that costly silver equals American independence and sovereignty. The selection is obvious and clear. And once you comprehend the selection the government has made, the investment thesis becomes straightforward and simple. You align yourself with the policy direction. You position yourself on the same side as the Pentagon, the Department of Energy, and the White House administration. You're not merely long silver as an investment. You're long American industrial policy and strategy. You're long the reindustrialization of the Western world economy. You're no longer merely long silver as a commodity. You're long the United States defense strategy for the future. The overlooked hero is finally receiving its recognition and voice. Silver is transitioning from the back of the cupboard to the forefront of the Situation Room and military planning. Yet there's a timeline attached to this transformation. The government advances slowly through bureaucracy, yet executive orders have strict deadlines. The proclamation establishes a clock ticking steadily. 180 days from signing, July 13th, 2026. That's the date when the negotiations must conclude. That's the date when the price floors and tariffs could formally activate and begin. Between now and July 13th, we're in a critical transition zone period. The old world of manipulation is ending and dying, yet the new world of price supports hasn't completely formed yet or taken shape. This transition zone is where the opportunity exists for investors. In the final part of this deep dive series, we're going to examine the countdown to the deadline. We're going to outline precisely what happens over the next 6 months leading up to July. We'll discuss how the smart money will anticipate the July deadline strategically. They understand that once the price floors are made official by the government, the discount window shuts forever and the opportunity ends. We'll also examine the trade strategy. How do you position yourself optimally for a market where the government explicitly desires elevated values? The overlooked hero is about to become the star of the show, and you have a front row seat before the curtain rises on the drama. The physics are undeniable and clear. The geopolitics are undeniable and compelling. And now the executive order is authorized and official. The path is clear ahead. We've reached at the conclusion here. If you've been with me through this entire geopolitical assessment and analysis, you now comprehend the complete scope of the paradigm shift taking place. You comprehend the legal power of the Section 232 proclamation clearly. You comprehend the economic necessity of the price floor to reconstruct domestic mining industry. And you comprehend the military imperative that makes silver a matter of national survival for America. The evidence is overwhelming and compelling. We're not merely looking at a market cycle of ups and downs. We're looking at a changing of the guard and power structure. The period of the central banker whose objective was to suppress the value to conceal inflation is ending now. The period of the strategic planner whose objective is to elevate the value to secure supply has started today. Yet knowing the why isn't enough alone. You must comprehend the when and the timing. Government policy doesn't advance at the speed of high-frequency trading algorithms. It advances at the speed of bureaucracy and procedure. Yet when it finally arrives at its destination, it strikes with the force of a tsunami wave. The proclamation authorized by President Trump establishes a very specific clock ticking inexorably. It outlines a negotiation period with trading partners to secure these essential mineral supply chains for America. The timeline is precisely 180 days. If we count forward from the signing date of January 14th, 2026, we reach at a critical date on the calendar, July 13th, 2026. This represents the checkpoint deadline. This is the date by which the new trade deals must be completed and finalized, or the unilateral measures, the tariffs, the quotas, and the official price floors could formally activate and take effect. For the uninformed investor, July appears like a lifetime away in the distance. They will observe the volatility today, the decline to $90 per ounce, and they will become distracted by the noise. They will believe they have time to delay their decision. Yet the smart money doesn't delay for the deadline to arrive. The smart money anticipates the deadline early. In financial markets worldwide, value moves in anticipation of an event, not following the event after it occurs. If the market understands that on July 13th exactly, the U.S. government is going to effectively guarantee a floor value for silver at a specific level, let's hypothetically say that floor is set at $120 to make mining profitable, the market will not delay until July to trade at $120 per ounce. It will reach there now immediately. Why exactly? Because no rational seller is going to release their physical metal for $90 today. If they understand the government is guaranteeing $120 in 6 months' time, sellers will remove supply from the market. Buyers will rush to anticipate the mandate early. The value adjusts instantaneously to the future reality that's coming. This is why the current volatility we're seeing, the decline to $90, represents the ultimate bear trap for investors. The banks are attempting to shake you out one final time before the political reality takes hold firmly. They're attempting to acquire your silver cheap before the government makes it officially costly through policy. So what's the strategy for the individual investor in this critical transition zone? We're currently in the gap period, the gap between the death of the suppression scheme and the birth of the support scheme that's coming. This gap is characterized by extreme volatility, confusion in the markets, and misinformation. Your strategy must be strategic accumulation of physical. You have a window of time, perhaps weeks remaining, perhaps only days, where the value of silver is still determined by the broken paper market in New York rather than the strategic value placed on it by Washington and Beijing together. You're acquiring a discount on a national security asset of strategic importance. Consider it like buying real estate in a neighborhood where you understand the government is about to construct a massive new headquarters building. You purchase the land before the announcement is public knowledge, except in this case, the announcement is already public. It's just written in legal jargon that the algorithms haven't figured out how to interpret yet properly. Yet there's a warning here for investors. The transition will not be smooth sailing. The banks, the entities that have benefited from suppression for 50 years, will not exit quietly into the night peacefully. They will combat this new policy aggressively. They will advocate against it politically. They will utilize their remaining paper ammunition to attempt and discredit the move publicly. You'll witness headlines attacking the price floor. Concept is anti-market. You'll witness economists arguing that free markets should prevail naturally, disregarding the fact that the market has been manipulated for decades already. Ignore the noise and propaganda. Observe the safety net. When the President of the United States authorizes an order mentioning price floors officially, he has effectively positioned a government guarantee under the market structure. Consider it as an insurance policy that secures you from the downside risk. If you purchase silver at $100 per ounce and the government establishes a floor at $90 officially, you understand precisely what your maximum risk is exactly. The government has just indicated publicly that they cannot afford for silver to collapse below levels. If it collapses, the mines shut down. If the mines shut, the missiles don't launch properly. Therefore, the downside risk of owning silver has just been transferred from you, the investor, to the United States Treasury Department. If the value declines below the floor, the government must act decisively to correct it immediately. If the value rises above, you maintain the profit entirely. It's an asymmetric trade opportunity. The risk is limited and capped, yet the reward is open-ended and unlimited. So, as we observe the chart trading around $90 currently, don't perceive it as an indication of fundamental weakness. Perceive it as a policy error that's about to be corrected soon. The decline to $90 expands the spread with China to $12 per ounce. It accelerates the drain of physical metal. It worsens the national security danger worse significantly. Paradoxically, the lower the banks drive the value today artificially, the quicker the government will need to intervene tomorrow forcefully. We're watching a collision between two irresistible forces battling: the deflationary force of the debt-laden banking system and the inflationary force of the reindustrializing state power. History informs us clearly that in times of conflict and crisis, the state consistently prevails over banks. The banks will be brought to surrender eventually. The value will be reset to higher levels. The national security pivot represents the final piece of the puzzle here. We have the physical shortage documented, video 1. We have the bank war analyzed, video 2. And now we have the political guarantee established, video 3 in the series. The stool has 3 legs firmly. It's stable and balanced. The bull market is no longer a speculation or hope. It's a policy objective officially. So here's the final verdict, clearly. July 13th, 2026 is the deadline on the paper documents. Yet the deadline in the market is now immediately. Don't delay for the official announcement of the floor value from government. By the time they announce it officially, silver will likely be trading well above it already. Utilize this volatility to your advantage. Utilize the confusion in markets. Secure your position while the paper value is still detached from the strategic value recognized. The United States government has just enlisted silver into the service of the nation officially. It's no longer merely a coin in your pocket for spending. It's a component of American sovereignty, and sovereignty is costly to maintain. Maintain your metal holdings, observe the countdown to July, and prepare for a world where silver is valued not as a commodity, but as a weapon of strategic importance.